Hello, good afternoon, and welcome to our webinar. Dobar dan in dobrodošli. Lizelle, please take over.
Good afternoon, ladies and gentlemen. A warm welcome from the sunny Cape Town, South Africa. And we thank you for joining us here on this live webinar hosted as in association with the University of Ljubljana, the Economic and Business School. Today, we would like to invite you to sit back, relax, and enjoy the session, this thoughtful and thought-provoking session with both our panel members, Prof Marko Pahor, as well as Dr Emmanuel Oduro-Afriyie. And today, our moderator for the session will be Dr Isa Omagu. Before I introduce Dr. Isa Omagu to you, I just quickly want to share with you our social media handles, which Mansa will put on the screen for us. Thank you. Please, we invite you to post and tag the business school as well as the University of Ljubljana when you do postings on the event. You are more than welcome to tag both of us in and on any of these social media pages that you are a member of or a follower of. Thank you, Mansa. And now I will continue to introduce you to Dr. Isa Omagu. He's one of my favorite alumni, if I can mention it on this platform. And Dr. Isa Omagu is currently the Chief Strategy and Development Officer for the Bank of Industry Limited. It's called in acronym BOI. Dr. Marko earned his PhD in entrepreneurship and small business management from the prestigious Babcock University in Nigeria. In 2011, he obtained his MPhil in development finance with the very own University of Stellenbosch Business School. And we are so proud to have Dr. Isa Omagu as an alumnus currently present to moderate the session for us. Dr. Isa is also a natural leader and an organizational builder with multidisciplinary training and experience and strong collaborative and teaming skills. Dr. Omagu served on the Stellenbosch Business School Alumni Association as the chapter chair for the West Africa alumni chapter, as well as on the Stellenbosch Business School Advisory Board for a number of years. I personally feel that Dr. Omagu is the recognized voice for our alumni, not just on the African continent as well as in South Africa, but globally. We will share the detailed bio with you afterwards. So I'm not going to go through the full bio. You are welcome to read it in your own time once we share the information with all the attendees. Yet again, another warm welcome. We have guests here from Botswana. I've noticed on the registration form from Zimbabwe, Zambia, Italy. So we wish you a warm welcome and we want you to enjoy the session. Please feel free to put your chats or your comments or your questions in the chat box, and then Mansa will then facilitate it through to our moderator, who will direct the questions to our panel members. With no further ado, I'll hand over to Dr. Isa Omagu. Thank you.
Hello, everyone. Thank you so much, Mansa and Lizelle, for the very kind words, especially from Lizelle. Sawubona. Hello. And then, good afternoon, everyone. On behalf of the Stellenbosch Business School Association, Alumni Association, it is my distinct honor to extend a warm welcome to this Euro Africa Alumni and Stakeholder webinar. I've already been introduced, Dr. Isa Omagu, and the Alumni Association is about 50 years old. The University Business School is over 50 years old. It's such a privilege to greet esteemed guests from around the world: Zambia, Nigeria, Italy, South Africa, Slovenia, including alumni, industry leaders, government representatives, academic partners, and students. We are delighted, in conjunction with the University of Slovenia, to host this thought leadership event in collaboration with the University of Slovenia, School of Economics and Business and Stellenbosch Business School. We encourage global dialogue that reflects our commitment to innovation, connection with industry, and responsible leadership. Thank you for joining us as we explore meaningful insights and strengthen our shared alumni networks. Our payoff line as a business school is to build responsible leaders for a better world. You all will clearly agree with me that this world needs to be better through responsible leadership across every level, from family through communities to businesses and countries. I'm hoping rather. Professor Marko Pahor is a member of the board of Bankers Slovenia. He's the vice governor. In Nigeria, Central Bank of Nigeria, it is called deputy governor, so it's equivalent of it. And is responsible for the areas of payments and settlements, resolution, risk management, and financial statistics. He's also a member of the high-level task force for digital euro and a member of the Single Resolution Board Committee. All of you here will agree with me that this is an extremely important and sensitive post to hold, given the nature and importance of payments to drive international trade and global economic development. Before joining the central bank, he worked in academia. His last position was full professor for statistics at the University of Slovenia, School of Economics and Business. His research spans a wide range of applied data analytics, a very topical subject globally at this point, and statistics, finance, and economics. Professor Marko Pahor, thank you for giving us the opportunity to be able to listen to you today. And we are looking forward to a very insightful session. I think what I'll just do back to back is also introduce Dr. Oduro-Afriyie. He's proud alumnus of Stellenbosch Business School. In his own case, he took a tougher role of doing a PhD. Mine was just simply a master's. Digital currencies and payments, an estimation of aggregate and sectoral threshold inflation rates, inflation in inertia, expected durations, and switching probabilities of inflationary regimes in African economies. He's been in global seminars and stages talking about some of these things that he has studied and captured with a PhD in Stellenbosch Business School. Dr. Oduro-Afriyie is also a Moody's certified credit analyst, and with years of corporate and investment banking experience across West and South Africa. He has covered the two African regions, both in study and practice. He was previously corporate credit manager at Absa Bank, Ghana, a member of the Absa Group, where he managed a credit portfolio of firms with a combined annual turnover in excess of $1 billion. He's currently an investment banking associate at Absa Bank, Ghana, where he's responsible for the structuring and execution of all debt transactions in the investment banking division of the bank. He's handled multiple landmark transactions across various sectors of the national economy. We warmly, in the Sawubona style, welcome Dr. Emmanuel Oduro-Afriyie, and look forward to also hearing his perspective on Euro-Africa perspective on digital currency banking. Ladies and gentlemen, we'll start with Professor Marko Pahor, and the floor is yours, sir.
Well, I would like to thank Dr. Isa Omagu for this very nice introduction. Welcome and to everyone, dobrodošli on this presentation. So what I will do today, I will present the Digital Euro project, So where do we stand with it? So why do we do it? And well, in the final part of the presentation, I will also mention a few of the recent developments. So most of the presentation will be about the retail central bank digital currency, which is how the digital euro started and which, well, what we think about the digital euro. But towards the end, I will just mention briefly there were some recent developments towards the so-called wholesale digital euro. So you will know what the European Union, what the ECB is thinking about how to approach this. Next slide, please. So first, a little bit of a divergence between why do developed countries and why do development countries think about the central bank digital money. There are different reasons. So you might, as you can imagine, in developing countries, you might have a big share of population that is unbanked, so they don't have bank accounts, they don't use banks. So consequently, there's a lot of cash is being used. So, but on the bright side, it's the development countries that often leap jump the developed countries in some technological innovations like mobile payments. So the developing countries are actually in the forefront of the mobile payments, and in mobile payments, the developed countries are the ones who are lagging behind. But nevertheless, so when developing countries are thinking about introducing central bank digital currencies, they mainly do it to increase financial inclusion of the population, especially the unbanked ones. Also to reduce the cash dependency, so people can use electronic payments, electronic money instead of cash. This goes for two ways. So also receive cash, for example, from the government. Also, a big question in developing countries is remittances. So what are people who go abroad to work sent back to their families? This might be very expensive to do. So how to make this cheaper, more efficient, faster as well? And yeah, focus on the innovations. Now, in developed countries, these focuses are different. One is about monetary sovereignty. So how to keep your own money. So how to prevent some private money, so cryptocurrencies and similar things to take over. A very important thing, a very important thing here to think of is as well the payment security and resilience. So having more different ways of paying, especially in the era of diminishing cash payments. It's also about efficiency, how to do it cheap, fast, efficient as possible. And it's also about technological competitiveness with existing providers. Now, if we move forward, so the foundations of digital euro. So why did we even start thinking? So we started thinking about this some 5 years ago. And there were several reasons. Next, please. There were several reasons for that. One of the main reasons was the dropping share of cash payments. So before the pandemic, back in 2019, in European area, 72% of payments at the points of sale were made in cash. Last year, this dropped to 52%, and in some countries, it's even much lower than this. On the other hand, payments with cards, of which I'll mention this later as well, most of the card payments, like 70% of the card payments, are with one of the global schemes, Visa or MasterCard. But this rose, so payments with cards rose from 25% in 2019 to 39%. And also what is on the rise is mobile payments, but they are still relatively small. Next, please. So the idea here when starting thinking about digital euro was, okay, so the world has changed. So we need to do something. All these means of payments, all the electronic payments, they rely on private money, so money that is in private banks or even in international schemes. So they're not central bank money as cash is. So how to preserve central cash money, not just because of preserving the importance of the central banks, but also to preserve people's access to central bank money. Because if there's less and less cash, maybe people, even when they want to get cash, won't get it. So we need an alternative, an electronic alternative to it. Also, there was a race of geopolitical challenges with subsequent crises that hit us in the past 5 years. So this is a very European perspective. First there was a pandemic and disruption of the distribution channels. Then there was the Russian invasion into Ukraine. And so there's a lot of geopolitical challenges. So we need to build resilience. And European Union, of course, part of this resilience and also the European spirit is having the euro and a strong euro. And we see that a central bank digital currency euro would do this. And obviously, one of the things that Europe really tries to do is to increase, to spur innovations. So another reason of why do we want to do this is we see the digital euro as a platform for innovation. So we want the ecosystem built around the digital euro that will innovate, that will give us new and increased ways of how to pay things. So in short, next please. What digital euro will do is it will adapt the central banking money to the current payment trends. So it will make an electronic central bank money. Then it will facilitate our lives. So it will make our lives easier, at least for the Europeans, because we will have a mean to pay in central bank money throughout the whole European Union at start and later, hopefully, elsewhere in the world as well. And obviously, very important thing for Europe is it will strengthen our strategic autonomy. Now, if we look at each of these separately, next slide, please. As we already explained, the societies are becoming more and more digitalized, and the way how people pay is changing. It has already changed, and it's changing even further. So besides using cards, debit cards, cash card, credit cards, debit cards, other sort of cards, also the mobile payments are on the rise, even though they still remain small. And we can see because of this changes that there is now a mismatch between how people would like to pay and how they are able to pay. And we really do believe that the digital euro will fill this gap, will actually help bridge us this mismatch between people's preferences and their abilities. And this brings us to facilitation, so making our life easier. Next, please. So this will give people in the euro area first, European Union, and then further on, an additional payment choice. So it's not supposed to actually eliminate what we already have. So we will still have cash, we will still have credit cards, we will still have Apple Pay, but we want to introduce another option. An option that will have a legal tender status, which means that all the merchants will actually be obliged to accept this as payments, same as they are obliged right now to accept cash. And we want to make this something that will always be available. And we'll talk about payment scenarios and what do we mean by this always available a little bit later. So the last thing is, of course, is the strategic autonomy of European Union. Next one. So the legal tender status, being backed by the central banks, makes the digital euro accessible across the whole euro area, and it will be a reliable, stable value. It's always, one digital euro will always be worth €1, no matter what. If you're unaware, so the euro to US dollar is approximately one on one, because we have an international audience today. Euro is a little above the American dollar, if you're more familiar with the American dollar. Can I have next slide, please? So in that sense, the digital euro will reduce the dependence of the European Union on private and non-private payment providers, especially ones that are not based in the European Union. But also, the digital euro will set grounds for private companies to further innovate and to develop financial services that bring potentially new business opportunities and add values to the customers. Can we go to slide 11, please? Okay, thank you. So, European Union the euro area has roughly 350 million citizens, and they already have, a bunch of, all developed countries, and we already have a bunch of payment options. So besides cash, we have credit cards, domestic and international. We have obviously bank accounts, instant payments, which still they're mostly country-based. There's also other digital payments like Apple Pay, Google Pay, Garmin Pay, and so on. But still, we do think that all these payment options, they are very limited. They either rely on some technologies that are not in the hands of European Union, or they are limited to countries, and the uptake of interlinking this to make this available across the whole union has a slow uptake. So there's lots of market failures here, which we do believe that the digital euro has a high potential to address. So first off, it's something that from the beginning will be available across the whole European Union, or at least across the euro area. So for all these 350 million citizens, or more than 400 if you take the whole European Union. Also, it will be free for basic use. Of course, banks and other payment services providers will still be able to charge something based on that. So we will have incentives for them as well. But for basic use, same as cash for basic use is free, and so will the digital euro be. Also, for European people especially, privacy is extremely important. And one of the biggest fears when talking about digital currencies is the fear of losing the privacy. So that the electronic payments will mean that we will lose the privacy. And we are designing the digital euro in such a way that it will offer a very high level of privacy. In some uses, even very, very close to the privacy that is offered by cash. And one of the biggest innovations, or probably the biggest innovation that we're offering, is that digital euro will be available not only online, but also offline. Next slide, please. So currently, there is, besides the euro banknote, besides the euro cash, there is, which is not digital, obviously, so there is no European digital means of payments that covers all the euro area countries. So there's no way of paying electronically anywhere in the European Union. There are ways of doing it with international cards, but the strategic fear here in the European Union is that the international card schemes are under the control of the United States, which, while we are friends, it's okay, but who knows what the future brings. So we do want this strategic autonomy. The national card schemes are not even present in all the countries. You might see the dark blues in this map. They don't have a national card scheme. Well, Slovenia there is light blue, but nevertheless, even this light blue means, we have a very, very small national card scheme. It's there technically, but it's not really used. Also, if it's a national card scheme, if you come from a small country, you cannot pay in other countries. So this is no good. Also, there are schemes for instant payments, which are mostly national. There are several initiatives to link or interlink these instant payment schemes, which has a very, very slow uptake. So the instant payments were around for the past 10 years, roughly. And since the very beginning, there are initiatives to interlink them across the different countries, but so far to very, very slow extent. So we really do believe that we have to offer something new. We have to offer another possibilities. So the digital euro would be a pan-European platform, and it would standardize digital payments for the entire euro area. Next. Now, in order to become a successful payment alternative also, it is crucial to offer as many scenarios as possible and to bring added value. So to have something that works always and that is as seamless as possible for the users. So we envision that digital euro could be used in person-to-person payments, of course, for payments at the point of sale, so to buy stuff in the shops or to buy stuff on the internet. Now, as I said, digital euro would work both online and offline. Nowadays, the digital payments only work online. So there's no functional digital payment right now that works offline. And the digital euro would work from the very start, both online and offline. Primarily, so also electronic payments nowadays, to a great extent, they rely to the use of phones or even smartphones, which might be a deterrent for some people. So if you want to include everyone, at least potentially, you need to offer also functionality without a phone, for example, with a physical payment cards. Based on that also, so payment modes, internet for online, obviously, near field communications, which probably will be the main type of communications for everyone, and also the QR codes. In some countries, payments with QR codes is highly popular. In Europe, not really. So maybe later on, you can share your options, your opinion about this, and your experience if you have some. Okay, next, please. Now, we really do think, of digital euro as the digital cash, right? And one of the things about cash is that, cash just works always. You have a banknote, you go to the store, you give the banknote, you get the juice. Simple as that. And, the digital euro should be simple as that. And also, cash always works. So, if your phone works, if it doesn't work, cash will work. If you have electricity, cash will work. If it's in the middle of the night, cash will work. And, if you call something a digital currency, it should really work just like that. It should always just work. Yeah, but the problem with cash, it always works, but not on the internet. You cannot, order something from the Amazon or somewhere, or Alibaba or whatever with cash. It doesn't work like that. So you need an online way of payments for that. For cards, you need a working communication. You need a phone line that works so that they can check the card. So it doesn't work offline. Same goes for electronic payment solutions. They work if the receiver is connected. Otherwise, they don't work. And the digital euro as digital cash, it has the best of both. It always works, and it's cash, and it works online and offline. And to the user, it should be seamless. So they shouldn't really even notice whether it's online, offline. For them, it should just work. So that's the whole idea. Next, please. I mentioned earlier privacy. Privacy in Europe is highly important. So that's why the digital euro has built in this very high privacy standards for payment providers. So especially in the terms of the euro system, which is seen as part of the bigger state, the euro system will not be able to identify people. Even with online payments, we will not be able to identify peoples. Also, all the intermediaries, all the payment service providers should be compliant with EU regulations, and EU is very strict about protecting the personal data. So we have the so-called GDPR, rules on privacy and data protection, which is a very strict regulation. So privacy is a big thing, and also offline payments will be very cash-like, So the system will only know that someone will load digital euros into their digital wallets. What they do with that cash later on, with that digital cash later on, they don't know. So this is very similar to how cash is. I mean, it's still electronic payments. So if you are a conspiracy theorist, you'll still say, oh, well, they can still trace you. But on the other hand, banknotes have serial numbers. So even with banknotes, they can still trace you. They're just not doing it, right? And no one has the ambition of tracing people. That's not the aim at all. So privacy is very important, and it's probably the most important thing when designing it, where we are willing to sacrifice a lot for protecting the privacy of users. Next, please. Inclusion is another thing that's very important, and we're also going the extra mile to really guarantee the inclusion. It would be much simpler to design a digital euro to just be used on the mobile phones, on the smartphones. But we don't want to do that, because we don't want to leave people behind who might be, technologically challenged or socially deprived, and or just don't want a smartphone. So we don't want to leave them behind. That's why the digital euro will be offered also on the physical cards. There will also be a system of support for the users. Now we see the offline functionality also part of the inclusion. So it's not only a resilience thing, it's also a thing of inclusion, so that it will work also in remote areas that maybe don't have connection all the time. So even inclusion is an important aspect of that of this. Next, please. Next. So a cornerstone for the digital euro and the distribution and the final success for it, of course, will be the payment service providers. So banks and other payment service providers, so they will be the primary distributors, just as for cash. So the digital euro will not be distributed directly by the European central banks and national central banks, but by commercial banks, same as cash. Because we want them to preserve the customer relations. We want still people to have their own banks, because now they have banks, and we still want them to have banks. And also we will allow the payment service providers to innovate. So this will be a platform. So we will enable them to innovate. And also we will maintain an open platform for standards, which will allow these innovations to take place. Now, in order not to challenge the commercial banks, there will be holding limits, which at the moment are still being calibrated, though we have a rough idea of how much that will be. In order to make this seamless to people, so not to burden people with what money am I using, how am I using, there will be a built-in waterfall functionality, and reverse waterfall. What we mean is, so there will be a seamless transfer of funds from your regular bank account to digital euro wallet and back, right? And also interest rates on digital euro will be forbidden. So no remuneration, either positive or negative, just as cash. Just as a sideline, there is it's not forbidden to actually remunerate cash. So to give you interest on cash, we just don't know how to do it. We would know how to do it on the digital euro, but that won't be allowed. So again, digital cash. So just to preserve this idea of being cash. Next, please. Innovation was mentioned several times in my talk today. So we do offer a platform. So what we say is, so we have this digital euro that can be used, but the digital euro in itself will not have automatic payments, reoccurring payments, and so on. So I don't know, you want to give allowance to your kids, you can't really just do it from what the central bank is offering, but of course we will allow commercial banks to build wallets that will have this option for conditional payments, automatic payments, and so on. And we do believe that this will spur a lot of innovation from it. So and we really do hope that most of this innovation will come from European players. So we really do want to strengthen this European perspective on the digital currency here. Next, please. So the current legislative process incorporates most of this things. So it's, just to be clear, digital euro is not there yet. It's not even sure that it will be. So there are still several steps to be taken. Though, can I have the next slide, please? One more. Yeah. Sorry. So, as I said, we started thinking about digital euro back in the year 2000, but then the project of digital euro started in 2021. So for 2 years there was an investigation phase, which concluded in late 2023. At that point, also there was legislation passed in the European Parliament, which is still there. So last year we had European elections. So things are a little bit slow, but we really do hope by the end of this year we will have the legislation in place so we can continue. But nevertheless, the preparations for digital euro are still ongoing. So right now we are in what we call preparation phase 1, so which will conclude in the autumn of this year. At the conclusion of this phase, a decision will be passed if we move to what will probably be called preparation phase 2, with some further developments of it. And after that, we'll go into piloting and then launches. So the dynamics for this is still a little bit unclear at this moment, but nevertheless, and also there are still a couple of decision points before we actually can say, okay, so we have the digital euro, which will look a lot of like I was describing it before. So we are still a few years away from it, from seeing it in production, but I'm pretty confident that we will, and not so far from now. Can I get the next slide, please? Yeah, thank you. As my last thing, this is the last development, namely. Last year, the European Central Bank joined an exploratory project on the use of distributed ledger technology and settling transaction on the distributed ledger technology. If you're a little bit of aware, when all this crypto story started, one of the fundamentals of the crypto story is the digital distributed ledger technology. And it can be very useful for trading assets, financial assets like shares, bonds, and similar things. Now, if you're buying securities, no matter of one platform, you have to pay them, and this is called the settlement. And the whole idea here was to settle. How to settle transactions in securities on these DLT platforms in different ways. So what the ECB did last year was it tested 3 bridge solutions. So how to actually settle securities on these platforms by adopting one of the money transfer facilities that are offered by the European Central Banks. There was huge interest in this. It was capped how many participants can do it. But there was more interest than that. So these experiments will actually continue this next year. And actually, the European Central Bank, in this respect, actually decided to do 2 tracks. So offer something that can be used off the shelf as soon as possible. So to make interoperable solutions of the existing services. But at the same time working, so in parallel to this, working on a long-term solution, which will be an integrated solution. So to make everything on the DLT, and here is where the wholesale CBDC or the wholesale digital euro actually comes in. So that the banks or other financial institutions will be able to use this to actually settle these payments. But there's more possibilities for this, and maybe something for the discussion later on. That this could offer an opportunity to improve cross-border payments. So this is all from my side. I hope I didn't go too much over my time, and I pass the word to my colleague, Dr. Emmanuel. Thank you.
Thank you very much, Prof. Marko. Thanks so much for that presentation. I think that was very insightful. So I will just really quickly from my perspective. I want to focus largely on the African perspective in relation to digital currencies. And on my initial slide, first of all, just to once again say a big thanks to Prof. Marko and to thank Stellenbosch University for the opportunity. I did love my time at the business school. I was there up until 2018. I would encourage everyone, if you're considering, please consider Stellenbosch University. Thanks for the opportunity. So really moving on, there are a number of digital currencies, and Prof has spoken extensively about those. The CBDCs, like the digital euro, the digital one, ECD, cryptocurrencies like Bitcoin, Ripple, etc., and stable coins as well. Largely, I will be focusing on the CBDCs. But before I delve into that perspective, I want to give us a view of the growing role of digital currencies in African banking. So you see on the slide on the far left, this was done in June 2022. It showed flashpoints of where digital currencies were being discussed or being thought about. On the right is the current position, and immediately you can see the increase in the number of dots on the map that are shown here. So this immediately gives a view that across the continent, there's a lot of interest around digital currencies in our banking space. Again, I'm just trying to still set the context. The IMF did a survey across 30 African countries last year. These were the countries they surveyed. And I just want to walk us through a few of the key results in relation to digital currencies. The first one essentially revealed substantial interest in engaging in CBDC development. Of the 30 respondents, 23 indicated that their central bank had already engaged in or will engage in some kind of research, experiments, or development work related to the implementation of CBDCs. And this result, I must add, is broadly linked to what was found in the Bank for International Settlements survey, which also found that 93% of central banks considering CBDC, undertaking CBDC work. And you will notice that while most of the countries engaging in this CBDC work are focused mainly on just researching, several others actually have concrete plans to complete their pilot or launch a CBDC in the next couple of years. Now, the countries already engaging in CBDC work, about 2/3 of them are undertaking research, and several other countries are actually experimenting with pilots, sandboxes, and other types of tests. A few countries actually plan to begin a pilot within the next couple of years. A little over a quarter of these respondents planning to launch their own CBDC within the next 5 years, with Nigeria already having launched in October 2021. And then countries, again, that don't intend to engage in any CBDC work for now have indicated that they are either focusing on other short-term policy priorities, or they prefer to just wait and observe the results of other countries' experience on the adoption of a CBDC. And over 50% of these countries prefer to prioritize private mobile money or other existing payments. On the next slide, again, I just want to show a few more results. Here we notice that financial inclusion and the efficiency of domestic payments were the primary driving factors for contemplating a CBDC in Africa. 90% of central banks responded that these two factors alone were motivations for engaging in or considering CBDC development. Payment safety and cross-border payment efficiency were also cited by 70% in one case and 57% of central banks respectively as motivations. If you look at the charts, other key reasons include reducing cash-related costs, modernizing government-to-person and person-to-government payments, and enhancing monetary policy transmission, which seems to be quite key on the African continent. And moreover, when asked about the extent of the importance of the various factors, financial inclusion and efficiency in domestic payments were deemed as very important by 2/3 of these central banks, while only 1/3 of them considered cross-border payments efficiency as very important. Again, still setting the context, we notice in this results that, Prof mentioned that they had noticed on the European side a downward trend in the use of cash and an upward trend in the use of digital payments. However, we see on the African perspective something quite interesting. We note here that a change in cash usage itself does not appear to be a factor for considering CBDCs in most countries in Africa, because many respondents don't anticipate a decline in cash usage, with the assumption here being that if there's a decline in cash usage, central banks may consider adopting CBDCs as a supplement or as an alternative to cash. However, over 80% of the respondents have not observed a decrease in cash in circulation, which is quite key for an African perspective. And furthermore, 2/3 of the respondents do not anticipate a decline in cash in use over the next 6 years, up until about 2030. Only 17% of the central banks reported that the amount of cash has been significantly declining. Indeed, some central banks even noted changes in payment patterns over the recent years, such as a slow decline in cash payments and an increasing acceptance and usage of card payments following the expansion of interbank networks. And again, about 40% of respondents noted that the COVID-19 pandemic had accelerated the planning of CBDC developments in the continent, with the aim of complementing cash, not replacing, but complementing cash and in-person payments, and with a bit to support social distancing and to enable access to central bank money in times of emergency. This slide is my final slide in terms of the context. On this slide, the question was around if the emergence of crypto assets had accelerated the planning for CBDC development. Most respondents, as we can see here, estimated that the emergence of crypto assets had indeed accelerated the planning of CBDC development. So growing interest in private crypto assets had raised concerns among most central banks about monetary sovereignty. And there was also an increased need for more efficient government transfers and the decongestion of banks during the pandemic. So these were key drivers. Again, most central banks consider trust, which I'll speak in some detail on subsequent slides. They consider trust, internet penetration, and financial literacy to be key factors for the successful adoption of CBDCs by the public. More than a third of the respondents agreed that trust of the public and internet and mobile penetration were key factors for CBDC adoption. Additionally, some of the central banks emphasized the importance of public awareness, the need for a well-established business case to drive it. The reason why a business case becomes important is because estimates for CBDC-related costs on the continent are ranging from $1 million to about $3 million just for development. And then they range from $100,000 to $500,000 for annual operating costs. And then from $800,000 to $3 million just for central bank infrastructure. So from an African perspective, when you throw in the depreciating local currencies across the continent and the dwindling foreign currency reserves, you begin to consider the business case. You really need to make a strong justification for the business case for CBDCs and a wider adoption of digital currencies across the continent. So having set this context, we can summarize that one of the primary socioeconomic factors influencing digital adoption on the continent is the quest for enhanced financial inclusion. Many countries in Africa grapple with large segments of our populations lacking access to traditional banking services. And the thinking has been that digital currencies have the potential to bridge this gap by providing financial services to the unbanked and the underbanked. In Africa, mobile money services have exemplified success stories. For example, in Kenya, M-Pesa has been a glowing success. And these have demonstrated how digital currencies can serve as a catalyst for financial inclusion and allowing individuals to participate more effectively in the formal economy. The extent of internet availability is another pivotal determinant in the adoption of digital currencies everywhere, but more so in Africa. And in Africa, in regions where internet penetration is limited or inconsistent, the potential for digital currency adoption is likely to face significant hurdles. Mobile penetration as well, particularly given the prevalent use of smartphones, plays a critical role again in the adoption of digital currencies in Africa. This is because in most parts, rural Africa, mobile devices are the primary interface for many of us, especially in regions where traditional banking infrastructure is not prevalent. Another factor to consider is the regulatory landscape. And it influences the digital currency adoption in Africa because the governments play a pivotal role in shaping the policies. Prof made mention around the thinking around the policies, the structure, and all of that. And these are key on an African continent as well, because they will either facilitate or hinder the growth of digital currencies. So clear and supportive government policies must be thought about, and formulated, and these should be aimed at creating an environment that encourages innovation, investment, and customer confidence in digital currency. And I'll take a step back. I think that trust comes in very key here, not just trust in the digital currencies, in the ability of the digital currencies, but particularly trust in investment. And I'll begin to break down across some of the African countries. In Ghana, for example, we've just gone through a rough patch of domestic debt exchange program, where essentially individuals and banks had to take substantial haircuts on their investments in government securities. And so generally, there's been that lack of trust. At least I can speak for from a Ghanaian perspective. If that trust is not there, even in general investments in the investment framework, then you definitely cannot get that trust in a digital currency that is being issued by the same guys who supposedly, inflicted that pain on the population. So that is another key point I must make mention of here in relation to the African perspective. So cultural perceptions around digital money, digital currencies, and levels of trust will significantly impact the levels of adoption. In Africa, trust is a fundamental element in any financial transaction, where on this side, cash is not just king, but I say it is the entire empire. So having that strong, independent regulatory institution in Africa will be pivotal to building that trust. So on this slide, I just will summarize by saying that the adoption of digital currencies on the continent is a complex interplay of a number of factors: socioeconomic, technological, cultural, regulatory. And we have to address these factors in a comprehensive and context-specific manner so that it creates that environment which is conducive for the successful integration of digital currencies. And at this point, policymakers, industry stakeholders, communities will need to collaborate to navigate these factors and unlock the transformative potential. And I think this is again very important because of the African Continental Free Trade Area Agreement, AfCFTA. So that becomes very key when we need to think around the role CBDCs and wider digital currencies would play on the continent. I would delve over the next couple of minutes into some comparative case studies. I'll be looking at the Ghana ECD, the Nigeria e-Naira, and the South African digital rand. In Africa, the adoption varies across these different geographies, and that's what my next couple of slides will be focusing on. So I'll start with the Ghana cedi, and one of the primary motivations for the introduction of the ECD has been to enhance financial inclusion, particularly for the unbanked and the underbanked populations. Mobile money in Ghana significantly improved financial access, and the central bank digital currency has been touted to offer a more robust and inclusive financial ecosystem. But this is what we have to think around the nuances, because in Ghana, about 45% of us remain unbanked, particularly in rural areas where banking infrastructure is weak. And unlike mobile money, which incurs some transactional fees, the thinking around the ECD was that it could provide a zero cost or even a low cost alternative for payments. And the ECD was also thought about to be able to link it to the Ghana National Identification System to enhance security and drive authentication and others. But as I've rightly mentioned, Ghana has a high reliance on cash transactions, which do come with a cost, rightly speaking, on counterfeiting, inefficiencies in handling, and security. So the thinking has been that if you could reduce the cash in circulation, you then minimize the costs of printing, transporting, and managing the cash. The thinking again has been that digital currencies like the ECD would be instantaneous, more secure, and even traceable, which would then reduce the risk of fraud and theft, particularly from an African perspective. I know Prof made mention that privacy was very key from a European perspective, but the thinking around it on this side is to reduce the risk of fraud and theft. And rightly so, because of the learnings from the mobile money systems that have come up over the last couple of years. So in Ghana, our mobile money ecosystem is very well developed. And so any success of an ECD rollout would have to require interoperability with platforms like the MTN Momo, Telecel Cash, Airtel Tigo Money. And we note that under decentralized cryptos such as Bitcoin and the like, this ECD obviously will be issued and regulated by the central bank. The thinking has been that it can be managed in real time to avoid excessive issuance and help to control or stabilize inflation. And again, I question this. The reason is when you look at the inflation breakdown for Ghana particularly, and for most African countries, there's a chunk which is imported inflation, right? So if the thinking is that this becomes a monetary tool, how effective could that be? You have to just think around those kinds of questions. The thinking again has been that the ECD will allow the central bank to adjust interest rates and to control liquidity, thereby influencing monetary policy and inflation. And again, the thinking has been that unlike cash, which traditionally is more untraceable, CBDC or the ECD will enable transparent transactions, and this would help to reduce tax evasion and illicit financial flows. That has been the thinking around it. I think that there are some good sides and some downsides to all of this. The good sides we talk about in relation to remittances. So the country receives over $4 billion annually in remittances, with a significant portion coming from the UK and the European Union. And so if we are successful with this ECD, we suppose that, I guess the thinking is that the cost of sending money across borders could benefit Ghanaians in the diaspora and their families. And particularly when we think about this again in relation to the AFCFTA, when it comes to settlement of payments and of trade and others, could this be something that could help? I guess these are things we have to think about. I would also speak towards the end of my presentation on the CFA and also how the digital CFA seems to play out. So I think the key challenges here are largely in relation to the adoption barriers and public trust.
It seems like we have some connection problems. So I will ask Dr. Isa to continue with the question session. Yes, please.
Hello, everyone. Thank you very much for your patience and for taking the time to listen to these two very extremely brilliant and interesting presentations by Professor Pahor and Dr. Afriyie. You know, listening to them, I didn't know how quickly time flew or time went by, but there are certain commonalities, that I've noticed. Dr. Oduro-Afriyie, would you like to just wrap up like in 1 minute?
Sure. No, that's great. I'll do that. I'll do just that. So I think really, I want to conclude in the words of one academic called Ozili in his paper in 2024. That essentially, central bank digital currencies can become a monetary policy tool. They can reduce the size of the informal economy. They can increase financial inclusion. They can increase digital financial literacy. They can reduce the circulation of counterfeit paper money. They can deepen existing payment systems. They can improve social programs and targeted welfare, tax evasion, improve tax revenue for African countries. But one thing we are not certain about is if it can completely replace cash in African countries. We don't think it will make African countries earn a developed country status. We don't think it will stop institutional corruption. We don't think it will stop illicit activities in African countries. We don't think it will reduce the level of poverty in African countries. So just, Dr. Isa, just in concluding, we think that any optimism by an African central bank about the benefits of using a CBDC should be tempered with an understanding of what can be achieved and what can't be achieved on an African context. I think I'll end on that note. Thank you.
Thank you, Dr. Oduro-Afriyie. One of the things I've heard said over and over again in the last couple of months is perfection is the enemy of good. So I guess starting is a good way to get into the future. And like Professor Pahor said, digital euro is currency for the future, even though I believe that the future is already here. And only yesterday, there was a news report about Namibia, looking to launch its CBDC to enhance cross-border payments and financial inclusion. So when I look at the digital euro, the ECD, or the e-Naira, and other initiatives that are coming up across the globe, what is a common denominator is the fact that they want to be able to they don't leave anyone behind. And that's where financial inclusion becomes a very central theme. The issue of regulation is also very key. And in fact, in some cases, it looks as if central banks across the world are playing catch up with fintech companies, playing catch up with, if you remember, Facebook a couple of years ago tried to launch its own global money system. And we're looking at really reaching out to 2.45 billion subscribers on their platforms. So this catch-up inclination by central banks is stepping in the right direction. And I guess that will probably also make it possible for them to effectively work with the practitioners, like Professor Pahor mentioned, where to minimize disintermediation of traditional banks, they are using them as the PSPs or payment service providers. So I guess that collaboration across the divide, whether it's regulatory divide, regulatory space, or the operators, or even us who are like retail users of CBDCs, those conversations have to happen, and they have to happen very fast in order for this feature to happen ASAP, so that we can reap the benefits of CBDCs while working on the possible flaws that there may be with respect to CBDCs. You know, honestly, this, I mean, I'm just enthralled here by the quality of submissions and the amount of information that's available for us to digest. Unfortunately, we have a time constraint. And so I'll now yield the floor to our distinguished participants here to ask a few questions. We're supposed to round up by 2:30 Nigerian time, 3:30 South African time. Unfortunately, I didn't check what time it is in Slovenia, but yes. So we start. I'll go to the questions right away. Clement Bott, please forgive me if I don't call your name correctly. Clement, I was told by
Byte. It's called Byte.
I brought a J. So Clement Bat. He also just basically commented that there's also the digital euro changes as well. So I guess maybe it's referring to similarities between the African perspective presented by Dr. Afriyie and Professor Pahor. The second point is there not a missed opportunity by embedding the new tech into the pre-existing banking system, in bracket, new wine in old wine skins? It's referring to digital euro. So Professor Pahor, I don't know if you got that. And if you can attend to that very quickly, please.
Well, I think I touched a little bit on this question. I guess, you know, this is a typical question, that one of the typical questions that we usually get from people who are in financial technology, who are in new things, and they say, like, okay, so we need something completely new because, you know, the current financial system, the current banking system, it's flawed, fundamentally flawed, and we need something different. Of course, coming from a central bank, we are part of the system and we think it works. And, you know, it might not be perfect, but a lot of things, they do work, and we don't want to destroy what works. We want to keep what works. We just want to, you know, keep improving it and implementing it. Of course, to some extent, it's better, you know, if you have nothing, to build something from nothing, you know, and you know, especially if you can rely on the failures and all the mistakes that were made previously, you know, if you have this possibility, it's great. But, you know, you cannot just, you know, totally destroy what you have, you know, it's too much of a risk. So, yeah, of course, you know, it could be done better, but, you know, we have to be careful.
Thank you, Professor Pahor. It's an additional question. The scope of inclusion that SBDCs, I guess that's Slovenia,
probably, yeah,
provide will be significantly affected by the devices that will be enabled to transfer, process, and store the currencies. I don't know what your take is on this submission.
Yeah, I think I also touched a little bit on this. Yeah, another thing is the two questions might be to some extent linked, because, yeah, the current payment systems, it's not just the banking system. They rely on some technologies that are there, that exist, right? And yeah, I mean, when we are building this, we try to rely on existing technology, on existing standards as much as possible, also because we don't want to burden not just payment service providers, but also merchants and so on with additional costs. So we want them to use technologies that are there, that they are already using, just adding some other means on these same rails, right? I mean, things will be affected by what exists, but yeah, we do want to have things inclusive for everyone. And yeah, I mean, the digital euro is still a few years away from now, and technologies develop, and then we try to incorporate whatever is there in the development. So yeah, it's not just one device. We want to make it to as many devices as possible. So that's.
Thank you, Prof. So, I mean, what I'd like to just add to that is, if you look at studies that have been carried out with respect to CBDC's development, one of the challenges that have been identified that you also spoke to is the challenge of technology and design. So it's not just the technology itself, or even the design. But according to World Economic Forum, the system needs to be cheap, fast, energy efficient, and unbreakable. Joshi and Joshi 2020. But such a system, most likely to be based on distributed ledger technology, is still a technical experiment with a high risk of issues. Design issues could further embed initial faults of the system. So I think people are already very familiar with some of these challenges that will happen. But like I said at the beginning, when I was commenting, I said, perfection is the enemy of good. So as these challenges exist, I believe that, especially with Professor Pahor in Central Bank, that they will begin to consider ways to minimize the challenges that they have, but progress needs to be made with respect to its adoption. I don't know if there are any more questions, Manza.
No.
Okay, so I think what I like to do at this point is to, in a bit to manage time, I did not go into any serious proper context setting. But I think that the way the speakers have spoken, there's really no need for any a priori context. What I just like to say is, based on my learning outcome from these presentations, which have been very, very lucid and very educating, and especially with respect to looking at the two perspectives from Euro and Africa, there are certain commonalities. And I think I mentioned a bit about regulatory landscape, financial inclusion, efficiency considerations. While we were having the presentation, power went off twice where I am, and I lost some of Dr. Afriyie's submission. It just shows you what he said about challenges infrastructure and how that can also affect trust. Because if you are processing an e-Naira or ECD transaction or digital euro and power goes off, then you're going to lose connectivity. That connectivity will now truncate your transaction, and you may now start having issues with your chargebacks, which can cause undue delays and also affect trust in the system. So there are all sorts of challenges that we'd like to face as we go along. But I think one of the things that Professor Pahor mentioned is the bit about resilience of the system being designed, and the fact that in Euro, for example, it will standardize digital payments across the Euro area, which is something that is very desirable. I also found a bit about comparison of cash, cards, e-payments, and the digital euro very instructive, especially along the online and offline business, and the fact that only the digital euro has a double tick. So whether it's online or offline, it's able to effectively still allow us to do transactions. So the concern raised by Clement Bat may also have been spoken to by Professor Pahor when he mentioned a bit about interoperability, because the new system have to kind of complement the existing system. And the idea is to be able to ensure that there's handshake between the old system and the system. So interoperability concerns are being also considered in the development of the CBDCs across the various countries. And ultimately, in the long term, there'll be proper system integration that can minimize and be able to have more confidence in the whole system. So in Africa, Namibia is the latest in the news with respect to considering CBDCs, even though IMF has warned them about the problem with respect to doing CBDCs. Eswatini is another country that has really made some progress with respect to CBDCs. Lesotho and South Africa, in addition to what Dr. Afriyie said regarding e-Naira and ECD. So I think that the future is here, even though Prof Pahor said digital euro is future currency. And according to International Bank of Settlement, about 80% in 2018 reports said that an overwhelming 80% of its members around the world were either researching CBDCs, working on proofs of concepts and experiments, or had launched pilot projects. And I think Dr. delved into those details based on real empirical evidence in his submission. So I believe that we're lucky at this point in time to have this kind of conversation, because whereas the rest of the world is considering the possibility of CBDC becoming a reality and the future almost being here now, we are already having some kind of exposure to its nitty-gritty, and hopefully we'll be better positioned to understand how it works, and either as regulators or as users or as bankers like Doc that's in Absa Bank, or myself that I'm in the development finance institution, be able to work together in a collaborative mode to improve this particular product, which is very desirable given its benefits despite the challenges. At this point, I think, so I'd like to thank you all for your very insightful presentations and very educative submissions that, as a person, may have learned a whole lot more than I knew before I came into this particular webinar. And I'm hoping that our distinguished participants here are able to leave here with something that they can work with, either as policymakers or as policy implementers or as users who are likely to be able to benefit from this very innovative product with all its inherent benefits. We still have a couple of minutes before we shut down at 2:30. I don't know if we can just leave one or two more opportunities for anyone that may want to say one or two things. Maybe like closing remarks by Professor Pahor and Dr. Afriyie. Clement Bat said that these questions that were asked by Andile Kuzuwayo. So he was conveying them. So thank you, Andile Kuzuwayo, for your very helpful questions. So Professor Pahor and then Dr. This is some kind of closing remarks, just basically to drive home the point.
Okay, maybe if I may, maybe I'll just link to what you were saying earlier about designing, Design. I mean, when you are designing a central bank digital currency, there's lots of consideration. But it's not only the central bank digital currency; it's any means of payments. There's all sorts of considerations. And as a central bank, you really want to do it all and cover it all in all the scenarios and so on. So that's why it's complex, and that's why for example, for the euro, it's taken a long time. And the euro system was not very vocal about this, but we've done a lot of piloting, and we are still doing piloting. So we have a lot of these experiments. But when we launch it, we really want to do it perfect. But no, there was another thing I wanted to comment regarding design. A lot of times, you really need to trade off. You cannot do it perfect. So for example, you would like perfect security and perfect privacy, and you just can't do it. Now, if you think about it, so one thing about security is that the system will allow some fraud detection, fraud prevention, so that in the system, if someone tries if someone breaks into your account and tries to spend your money, the system would detect this and block this person, which technically can be done. But the more we know about you, and the more we know about your spending patterns, the better we can do that. But of course, in order to know things about you, we need to know you.
Yeah.
And we don't really know you. So how much privacy are you willing to sacrifice in order to achieve higher security, and vice versa? So, and there's lots of these trade-offs when you're designing this, and in the end, it's really about where to strike the balance and how to make an optimal currency. So you cannot make it perfect, but you can make it optimal, at least for your target audience. So for people for whom it is meant. So
thank you very much, Prof. That's additional insight that is very helpful in terms of trade-offs and balancing of objectives. Doc, over to you, sir.
Thank you, Dr. Isa. So I think one of the things we learned very early on at Stellenbosch University during the program was to always take into consideration the context of a geography. And I like how Prof took from the context of the European Union. He made a point around interest not being paid on the digital currencies. And it hits me, right? Because the thinking in Africa has been that if you want to incentivize people to go the route of the digital currencies, you should be willing to pay some interest, on the digital currency they hold. And if you think about it from an African perspective, that is pure logic. That actually looks like it should work, right? Because in Africa, like I mentioned, cash is not just king; it is the empire, right? So if you want people to, and mobile money has been very successful. If you want people to move from that and to trust something new, you might want to incentivize them. And some of the suggestions have been around pay them some interest. I just wanted to end on that point around how context on the same topic becomes very interesting. Thank you, Prof. Thank you, Dr. Isa.
Absolutely, Doc. I mean, it's amazing how context makes all the difference. And then you know how they say, if you write a 6 and somebody else has on the other side, what he or she will see is a 9. So it's an extreme, a very practical example of how to really look at it from different perspectives. I know that Christelle is about to give the vote of thanks, but as a very proud alumnus of Stellenbosch Business School, and by the way, my co-alumni is here, Dr. Emmanuel. The goal of the alumni association is to promote the association as the most desirable in Africa. We want to create a lasting reputation, and I think that most of us that have passed through that school are truly living it out in our respective roles and locations. We also want to offer mentorship across board. There's even a conscious platform in the alumni where we volunteer as mentors to possible new students that are coming, or that people that may want support. And then very importantly, and most critically, as social animals, our fourth goal is to create and maintain connections. This is one clear way of reaching out not only to alumni, but to industry leaders, to regulators, and to students and potential students who will see the value of coming to an institution where there's a lot of emphasis on building, training you to become a very responsible and ethical leader, so that hopefully, regardless of which part of the world you are and the context they're operating in, you'll be able to make a difference and cause positive social change in the lives of mankind. I'll hand over at this point to Christelle, the indefatigable head of the Alumni Association Office, to give the closing remarks and to again thank Professor Pahor and Dr. Emmanuel for these excellent presentations. Christelle, over to you, please.
Christelle, we cannot hear you.
My sincere apologies. I was still on mute. Thank you very much. I'm Christelle Cronje, Alumni Manager at the Business School. Thank you for those beautiful words, Dr. Omagu. And on behalf of the Stellenbosch Business School Alumni Association and the University of Ljubljana School of Economics and Business, I would like to thank everyone who contributed to the success of this Euro-Africa webinar on digital currencies and banking. A first for us, as I told Dr. Omagu earlier, the first time we have our esteemed Africa alumni, Ghana, Nigeria, in with this webinar in discussion with Ljubljana. To all our distinguished speakers, Prof Pahor, your expertise and insights also really highlighted the transformative potential of digital currencies. Special thank you to Dr. Omagu. Your skillful guidance ensured us to have a really engaging dialogue. And then thank you to all the alumni, both universities alumni, industries, leaders, Europe and Africa, for your participation and staying with us throughout this webinar. Thank you all for making this a success and for your participation. Till we meet again.
Thank you.
Thank you.